Hello, everybody. Welcome to Friday, another Talk Money with Tom show today. Really happy to be here. Just right up front, I want to make sure people know that we won't actually be here again until the 16th of January, just because of the holidays and different vacations and such too. I'll probably try to still do some of the summaries on the Fridays, but we'll do the official show again basically in a month. We do the show, live on purpose. We like to get live questions. We want to be able to have you, send those in either through the email. Here's the address right here on the screen, or you can do it in the chat. We love to try to answer the questions as they come in. You can send in those questions during the week or even during this next month when we're not doing the show, and we can kind of gather those also. We get a lot of great questions and situations that come up in the strategy sessions with our clients that we think maybe everybody could gain from. So we often try to answer those here also. So the channel is here for your use. It's free, of course. You can subscribe to it. You can hit the bell button if you want to get notified, when we have something, new come on the channel itself. And of course, if you just want to meet with Ethan and I, you can go to our calendar. The book appointment button's up in the corner. You just go straight through to our website. There's a link here for that too, and you can set up a 30-minute time with Ethan and I to, phone, video, in office, whatever works best for you, just to talk about your situation. So, look forward to any chance to do that. Now, every one of the shows we start off with a summary of kind of what we saw happening this week in the stock market. I do a summary each day. Usually miss one day a week now, but 3 out of the 4 other days I'll do a summary. And then, of course, on Friday we try to, summarize what's happening for the whole week. This was a good week altogether, mainly because, the Federal Reserve cut rates. I'd say that was the big highlight of all the things. Market should be up for the week, although it is down today. The big issues that's happening this week in terms of, if you want to focus a little bit on the negative side, is just companies like Oracle and Broadcom are announcing, how much money they're spending on AI. I think Oracle was like $300 billion as far as that goes. Some of that heavy reliance is upon OpenAI as a company, and I guess we're going to head into this period now where we start to question, like, okay, we're spending all this money. When are we going to get some money back? As an investor, you're looking at that, okay, this is an outflow, and, is this going to pay off? I very much so remember this exact type thing happening in the dot-com, time frame, where it was like, hey, we're doing all this investment, we're building out all these routers and such, and what's going to be the payoff? Who's going to gain from it? Those types of things. And so I think we're heading into that phase of this. The difference is that the dot-com build-out was smaller in a way. It wasn't these big companies doing these giant data centers. It was all companies trying to do smaller projects like upgrading their internet infrastructure, their routers, and all those types of things. That's why Cisco became the #1 company in the world for about a week or something because of that. So, this is a bit different as far as that goes. But nonetheless, we're seeing some rockiness, and some maybe less returns than we might be getting, and some rotation. I'll call it the old economy stocks. Financials are doing better this week, for example, and so there's some rotation out of those AI type names and into these other areas. I think it's just part of the volatility. Those other areas that are in the AI have already run so much, you're bound to see pullbacks on a regular basis just because there's been a lot of profit made already, as far as that goes. So, the big news, of course, was about the Federal Reserve. So they cut rates by a 1/4 point, right? And every quarter they put out what's called a statement of economic projection. They put out their dot plot, and so it's not working. Okay, that's fine. And so what happened was the consensus estimate for next year was to have a rate cut of 1/4 point for the whole year. Now, the market was at 3 rate cuts of a 1/4 each, dropped down to 2. If you look right now, the bet is for April. So sometime in that April to June time frame is where the market's kind of betting, which means we don't have a rate cut in the January meeting or the March meeting as far as that goes, as far as the market's concerned. And I was very much so, Chairman Powell during his speech talked about, hey, we're doing this rate cut, but we're going to most likely be watching very closely for data, but otherwise we're not expecting rate cuts early in the year next year. And so now we had some interesting things, and the vote was 9-3 for the rate cut. The last time we had a vote like that was in 2019, so it's not very common. Usually it's 12-0. And so one of the dissenters wanted more, a half a point. And now this is Stephen Moran. He was assigned to the board by Trump. He's been the guy at a half a point every meeting since he started.
Been pretty aggressive with his rate cuts.
Yeah, and of course, if you look at the statement of economic projections and the dot plots, you can see his dot. It's pretty for projection for going forward, at least for the next year. It's quite low. And there was two other that didn't want to raise rates, lower rates at all, because they felt like inflation was more of a threat. So, anyway, that was a big deal, pretty much in line with what the market was expecting. The market, actually closed at an all-time high yesterday, which was kind of nice, not by a lot. Unfortunately, today, with the results that came out from Broadcom's earnings, the market is down, and we've come back below that high point. That's not a great sign. Usually when you break through, you want to be through for at least a few days and kind of running and not coming right back down the next day. So there's a little bit of resistance, obviously, for this market to continue running upward. We'll see what happens, next week to kind of play that out. But there was I thought, some very interesting things that came out of, kind of the conversation. So first of all, the Federal Reserve, as a staff, increased their projection for gross domestic product growth from 1.8% to 2.3% for next year. So they're expecting more growth than they were. That's good. 2.3 is kind of an average, really, so it's not a bad number. But they did talk about, they talked about their concern about the jobs report. So they're using all these, and this is from the Fed staff, they're using all these privately available, reports for how many jobs are being created, and they're looking at what the government is coming out with job creation, and they said the government's off by an average of 60,000 a month, essentially since they fired the person that was in charge of doing those jobs reports, the head of the BLS, and they're overstating. So in other words, they're showing an average of 40,000, since April, a 40,000 jobs increase, and it really should be a 20,000 jobs decrease. Now, these reports are always wrong, right?
Yeah.
I mean, they get restated and what have you, but what the Fed said was a warning that the restatements could be even bigger than normal, and that they were having to kind of factor in this discrepancy in their decision-making process. And this is kind of interesting, because if you really are overinflating the jobs numbers, that makes you look good in the short term. Hey, we're creating jobs or what have you. But if you're trying very desperately to get the Federal Reserve to lower rates, you would have been better off letting those actual numbers come through with that negative for the jobs growth, because the Federal Reserve might have reacted more strongly to that, or even maybe reacted so that there's more rate cuts in the beginning of the year next year, or something could have changed with those numbers.
Yeah, and it could be just that there's been a kind of a switch in the economy, in the sense that for a person, it's easier to become a gig worker, where you're working for maybe a DoorDash or an Uber, than it is to apply for unemployment. And so it could be a shift where you see a lot more people take on gig work and the government's, considers gig work employed individual. And so it could be a shift in that kind of sense, where a lot of these private reports, they have trouble quantifying when someone's an independent contractor. Like when you work for Uber, you're not actually an Uber employee, you're an independent contractor under him for...
Yeah. And it'll be interesting to see how it plays out altogether, right? I mean, we're in a race for this AI dominance. These companies are all trying to make it, and the market is questioning that race, questioning the expenditure now, of course, after a year or more of running the price up. And I guess the thing that I look at, just as my own opinion, these are a lot of really big companies that are super successful, that have a lot of spare cash flow and have been really good at what they do. And they're all pursuing kind of the same thing, kind of through the same people, through OpenAI and NVIDIA and whatnot. Some of the same companies are benefiting. But, the market is being wary of their success. I don't know. I'm going to give them the benefit of the doubt, at least to a certain degree. Which one is going to win? I don't know. That's kind of why we own the indexes, right? Because we can basically say, well, somebody out of there is going to win. I mean, going back to the .com, Amazon was always there, but it wasn't always obvious that it was going to be one of the big winners that came out of there.
Yeah, and so the indexes get your exposure to kind of a little bit of everything, the picks and shovels, the actual AI companies.
Yep.
Because a lot of times, during the gold rush, you can think about it, the general stores that were selling the picks and shovels were the ones making the steady income. They were just selling a lot of things, but they didn't need to have to actually strike it rich. They didn't
Yeah.
have to find the nugget.
Yeah. Yeah, and it's I look at the S&P 500, and to me that looks like the cream of the crop. Obviously, the top companies are very obvious, but across the board. And so if you have a big push into one particular area, it's either some kind of collective mania that is incorrect, right? Or they're right. And these are companies that have been right enough to end up on the S&P 500. To me, it's a pretty exclusive list. These are some of the companies that are really good at producing earnings on a regular basis, dealing with the different problems, whether it was the COVID or what have you. So, you own these indexes, and if there's a shift, like right now, there's a shift from this AI component to the old school. That's going to hit the indexes a little bit just because they're capital weighted. So the AI component is a big piece now with these Mag 7 all kind of involved in that to a large degree. So, however, there still is some compensating, so if you're just in the QQQs, for example, the top 100 NASDAQ stocks, that got hit a lot harder today than the S&P 500 because the S&P 500 isn't as concentrated. It's still concentrated, but not as much. So anyway, that's where I think some diversification kind of plays out here as far as that goes. But not a bad week to be in. Again, we're very close to a new all-time high. I think the market is, in the middle of this kind of Santa Claus rally time frame. Usually does at least seasonally pretty well. So there's some forces here. There's enough forces on the upside to kind of keep things rolling as far as that goes. I think the stories for next year will just be really heavily towards the Federal Reserve, the replacement of the chairman. There's some rumblings about trying to replace some of the other board members. Independence of the Fed is going to be something that gets talked about a lot because countries that don't have an independent Fed, that's like Venezuela, Turkey, places where they have massive inflation. So because politicians don't want to raise rates because it hurts. That's why you make the Fed independent, and they can take that blame, and they don't have to worry about getting elected at the next midterm and those types of things. And that's why they keep it independent. And that's why it's the gold standard, and internationally it's a big deal. So I think that'll be a big piece of the component we talk about next year. And of course, the tariffs will continue to be a big piece. Now, I think one of the most amazing things that the Fed said, Chairman Powell said, was that they feel like tariff increases to prices are temporary, and so inflation should be temporary. So they're thinking by the first quarter of next year, we'll kind of be over the hump, and we'll start to see inflation actually fall from the 3% range that we're in now. Now, there is some projections that will actually go up first before that happens. The problem, what they're trying to do there is they're trying to kind of engineer the public as a whole, because when the public starts to see inflation as an expectation going for the future, it creates two problems. Number one, they start buying more now, right, which creates inflation, sort of self-fulfilling prophecy. And number two, they start asking for more money at work because they're expecting things to cost more, which again can increase the costs, right? And so that's why you hear the Fed talking about transitory or temporary. It didn't turn out to be true in the pandemic recovery. I mean, unless you consider 3 years transitory, it took a long time for that to work. Yeah. And so I would be a little surprised if it turned out to be true here, but that's why they're saying that. They're trying to, calm down the consumer's expectations. It's why they talk about consumer expectation surveys so much. If you listen closely, you can tell what the Fed thinks is important, and that's one of them. So that'll be interesting to see how that plays out over the course of this next year. So anyway, a good week to be an investor, in my opinion. And obviously, we'll cover this again. Should be able to do a summary next Friday at least. We'll see how that plays out. So look forward to talking to you about that then. Let's get into some of our questions.
Let's take a quick break to see if we can fix that screen share.
Oh, yes. We're back. We got it fixed. Let's. All right. So, what is our first question we want to talk about today?
So, why is the market so wary of the large capital expenditures from AI companies like Oracle? Um, you know, a lot of times you've been told you have to spend money to make money. So why is the market so wary of these large expenditures?
Yeah, I think first of all, the magnitude is much. Spending money to make money is exactly right, but the magnitude of what you're spending obviously increases the risk. So if you spend, 30 million versus 300 billion,
Yeah.
so I'm spending 30 million on something. I'm taking a risk, and for a company of Oracle size, is probably a pretty small risk, versus 300 billion. Okay, now we need to see some, results from that, or the risk profile is higher than I want. I don't know where the stock is at the moment, but it was down about 40% off of its high, as of earlier this week.
Yeah, I think investors are coming to terms with that. With these high capital expenditures, there's no clear, return yet. We don't know we're starting to see some monetization of AI, but we don't know what the defined, monetization is. So it's like if I go to a shirts factory and I know I'm going to put a new line into that clothing manufacturing, I know if I produce this many shirts, I'll make this much profit or extra revenue. But with AI, it's hard to tell. So you have these companies. Oracle is one of those picks and shovels, so they're data center focused, and so they're trying to get like all these different data centers up, and will these other companies need these data centers is another thing. And so I think they fell down because their current earnings were a little bit less than expected.
Yeah.
But then also the revenues, their capital expenditures gain up to, I think they're expecting it to be around 17% of their entire revenue. So it's quite high.
That is high. Yeah, it's a race. Yeah, it's
Yeah.
a race to try to create all of these things and to get in front and to try to win this race, because the perceived, by the group anyway, is that there's generally, huge wealth to be produced if we can get in front of this. I think that this reminds me a lot of what happened kind of during the dot-com arena, because you had all these companies that were getting a lot of eyeballs. Facebook, Google Chrome, and everybody, they didn't have any earnings. They didn't even have really any significant revenues. And people couldn't figure out how the heck Google was going to manage to make money off of this search engine, And I know it seems crazy because now obviously they figured that out. That's the same thing that's happening here. You can't see right away what we're going to be making off of this AI technology.
Mm-hmm.
But the one thing I did learn is that the really good companies that have demonstrated themselves to be very good for a long period of time generally did quite well. They figured it out. Not everybody's going to make it, and maybe Oracle doesn't, but Oracle's got a great track record. They've got an owner who has, he was the wealthiest person in the world for a period of time before the stock came back down, but nonetheless, they've demonstrated those capabilities. And so that's the thing I keep going back on mentally, was just, hey, let's give these guys a chance. This is a different scenario. We're reporting quarter by quarter, not year by year or 5 years by 5 years. We're reporting quarter by quarter. And when you do that, when you spend a lot of money, especially if you're not borrowing or whatever, and it hits your earnings report, you're going to get penalized for that. I don't know if you really believe in the company, you'd want to buy more just because, basically, is the company right or is the market right? Okay? Sometimes the market's right, that's for darn sure, but I always try to give the benefit of the doubt to, is this Oracle isn't some fly-by-night that just started, a year ago. That just, like, you got to wonder to a certain degree even about OpenAI. They're a lot younger than Oracle. They're not public yet, so it's hard to see what they're doing. That could be the greatest company ever for all I know, but it's newer. You'd have at least some questions. Whereas with the Oracles and the Facebooks and the Microsofts and all these companies that are putting this huge amount of money, and Amazon going after this whole, AI/robotics component. Again, you're bound to be wrong. Not every company comes out with the right things every time, but these companies do it more often than most. So that's kind of how I look at it.
Yeah, and I think a lot with the picks and shovel companies, a lot of fear is that you're depending on like a handful of big clients to make up most of that revenue. And so if there's any weakness for those clients, for example, with Oracle, I think this morning they said that they're pushing out the open AI data centers from 2027 to 2028. So that 1 year it makes investors just kind of wary about, are you spending money?
Right.
The people that are actually going to be buying or purchasing or leasing these
Right.
data centers, are they going to still be around?
Yeah, I mean, you look at this and you say, oh, maybe I should buy in the dip because these companies might be right. Although the problem is they ran up so darn much, that really they might just be coming back down to some reasonable value that's not a significantly dip buying value, if that makes any sense. So, yeah, I think, though, that one thing that's kind of interesting here that will keep things rolling, the dollar amount matters in the sense of it becomes, you look for moats. You look for a company's ability to kind of hold on to something that other people can't do very easily. So if you have the capability of spending $300 billion on your data center build-outs, not everybody can do that.
Yeah, data centers aren't quick to build either.
No, they're not. And, some of the companies that are your clients could actually do that. And so that's what, like, NVIDIA is seeing that, where they're talking about these companies making their own chips. Yeah, as far as that goes. And so NVIDIA takes a little hit for a little while for that. And, honestly, with that much money going into any one market, there's bound to be some competition at some point in time that comes along from someplace. But nonetheless, I do think it's a barrier to entry. And so that's actually sort of an advantage. So if Oracle can get these things built, whether it's in 28 or 27, can they really benefit from that? And there's still a lot of questions there, but they will have a moat that they built. Like you say, it takes years to build them, takes hundreds of billions to build them. Not everybody can do that. And so it's going to put these companies in a kind of an exclusive position to a certain degree. There's a lot of pieces to figure out, like how do you power these things reliably and safeguard them also, and those type of things. But nonetheless, yeah, it's a good question. I think it's very interesting. I am holding out my optimism because all of these companies that are run by people that I respect in terms of their abilities to run an S&P 500 companies are excited about it. And so I'll stay a little bit excited about it until we see what does happen. But so far, I still think it's something worthwhile doing.
So what are the contribution limits for retirement accounts in 2026? So it's coming to the new year, and so you have to update your accounts and all that kind of stuff. Just your monthly contributions to make sure you're hitting their max if you're doing that.
Yeah, we've got a little. This comes up quite often this time of the year, especially. We've got a little, couple little visuals for this, and so contribution limits. So IRA, it's going to be $7,500. If you're over age 50, it jumps up to $8,600.
Yeah, it's a bit unusual because for years it's been $1,000 for the catch-up. This year's the first year in a while they added $100 extra to that catch-up.
They got it indexing on the catch-up. I don't know. I don't know what the factor is to create that indexing, but nonetheless, yeah, it went up $1,100 instead of $1,000. And so then a 401k is $24,500, and they have a catch-up provision, or one of the catch-up provisions anyway, is $32,500. So that's kind of a simplified measure for what the contribution limits are as far as that goes. Now you can dig into that a little bit farther, and it kind of depends on there's some other pieces. So as we mentioned, the employer contribution for standards going up to $24,500 on the 401k, 403b limits, which is $1,000 higher. The catch-up contribution goes to $8,000, right?
Yeah.
And now, but there's a super catch-up.
Yeah, so
that's new.
Yeah,
right?
They added the super catch-up. If you're between the ages of 60 and 63, you can contribute. Your catch-up contribution is a little bit higher. So if you're looking to figure out your catch-up contribution, it would just be your employee, or your max contribution. It would be just your employee contribution plus your catch-up.
Yeah, so you're going to be $24,500 plus $8,000, or if you're 60 to 63, $24,500 plus $11,500, which is what, $36,000?
Yeah.
So that's pretty good, right? You can put in $36,000. Now there is a total max because the company can match. Right?
Yeah. So as an employee, you could do up to your max contribution, and then let's say your employer has, like, a very common one is 100% for the first 3% that you contribute.
Yep.
And so that could go above the max contribution as long as it's below that kind of total contribution max.
Yeah. Yeah, so you cannot, through any source, get above $72,000 next year into your 401k, And again, those sources are your contribution, the company's match, and you can even put after-tax dollars in if you so desired, but still capped out at 72,000.
Yeah. So let's say you're a super saver and you maxed out your employee contribution, which is and your employer match, and you still have some room. Some employers allow you to do what's called an after-tax contribution. So you won't get any kind of tax benefits now, but when you do contributions to it, it's kind of like an after-tax. So it's a sub kind of group in that 401k. But the nice thing is when you go to roll it over, that after-tax portion is considered a Roth portion for your and so it gets split into a Roth IRA when you kind of do a rollover, which is very nice because otherwise, sometimes you get stuck, especially when you do IRA contributions. If you do after-tax IRA contributions, you still get stuck on that coffee and cream pro rata when you do Roth conversions.
Which gets messy.
Yeah.
Yeah. And then now they still have a catch-up contribution. If you're over 50, you can actually go from 72,000 max contribution from all sources to 80.
Yeah.
Which is nice.
Yeah.
Which is a lot, right? So theoretically, you could have an awful lot of money going in to your accounts, when you're older. Of course, it gets to 83,500 if you happen to be in that 60 to 63 window. So
you have to be quite a saver to be putting that.
Yeah. I mean, the idea would be, I forgot the stats, but they're really incredible. Age 55 to 65, the percentage of money saved for retirement it's huge. It's 60, 70% of money saved. And there's a reason for that. You're younger, don't have that much money. Then you're establishing yourself, you don't have that much money, and then maybe you're getting a family and a mortgage, you don't have that much money. Then you got kids in college, and maybe if your income's high enough, you have something left over through all of this, but sometimes it takes till age 55 to get through all of those high expense areas, and then you've got more, and there's nothing like motivation staring you in the face when you're 10 years away from retirement or something along those lines to really motivate you to save. And then just the final breakdown here.
These are all the individual kind of accounts.
Yeah, so this, you guys can, I won't go through all of these and bore you. You can use this and freeze it and take a look as far as that goes. But just on the different types of pieces, whether it's Roth, what's the catch-up, SEP IRA contribution maximums, and all kinds of things.
Yeah, unfortunately with SEP IRAs, you don't really get that catch-up.
Yeah, that's right. But it is very high, limit. So we've got some clients that have been able to put away some pretty serious money over the years in SEP IRAs. A lot of times, you have your own business. It's a sole proprietorship of some type, and that really is where we're seeing those contributions come from. Okay, so that was a good question.
So, what is an IRMA, Cliff? IRMA is the income-related monthly adjustment amount for Medicare, and so a lot of people, it's basically the tiers of premium for Medicare is what a lot of people call them.
Yeah, so IRMA comes up a lot. This is we've got the chart here so you can see what it is. So Medicare is means tested, which just means that the more you make, the more you're going to pay, right?
Or
at least temporarily.
In a sense, it's less of a discount because Medicare is subsidized by the government. So if you're in a lower income, they subsidize more. And so they just subsidize less as your income goes up.
None of my clients think about it that way. They'll think about it as more money out of my pocket. And so the reason they call it a cliff, there's a couple important things here, but if you look, if you file as an individual, 106,000 or less, joint 212 or less, just double that. File marrying, separate is the same as single. Your payment is 185 in 2025. That's changing every year, but nonetheless, 185. So why it's called a cliff? If I'm a single filer and I make $106,001.
Yep.
I move to the next level, which is $259 a month.
And then you have to pay that premium increase for those next 12 months.
Yes, and so that is the one thing that's important about this. You'll notice that it says if income for your from 2023. This is for 2025. So they look back 2 years.
Yeah, and that's really because we don't know our income till the end of 2020. Let's just say 2023, you don't know your final income till 2024 is when it's reported. And then you have to file your taxes in 2024. And so the IRS only reports it to Social Security basically in 2024, and so they do it for 2025. So there's just
Yeah.
a lag period in how long you know.
Yeah, so two key things to remember there. It's looking at your income from 2 years ago. So if you're doing something today, like selling a house or something that might jump you up, 2 years from now, your payments are going to go up. But they're not going to stay up
Yeah.
because it looks back for 2 years every single year. So if you had, we've seen this a lot. Somebody sells a house, they get that big capital gain, it bumps them up into a higher Medicare cost, but it's only for 12 months. And then because they didn't sell a house again, it goes back down to where it was before, and they usually drop back down. So it's just part of the cost. It's sort of like, we're all looking at the capital gains cost and what's the state and all that type of stuff. But if you're over 65 and getting Medicare, there's also this potential increase in your Medicare costs, at least temporarily.
Yeah, that's also something to consider when you do Roth conversions,
Yes.
whenever you're increasing income. So some people convert, instead of converting into tax buckets or tax brackets, they convert into IRMA brackets
Yeah.
instead.
Yeah.
So it's a way of kind of thinking about how do you want to control it. IRMA is not as forgiving as a tax bracket, because if you go $1 over, you're only taxed that $1 at the higher tax rate.
Right. Yeah, if you're a dollar over the 24% federal tax bracket, you're now, that $1 is going to be taxed at 32%, right?
Yeah.
Which is the next bracket, which is what, 32 cents. So,
Yeah.
not a big deal. But if you go $1 over on here, as we mentioned, you might go from 185 to 259 or what have you. And so as part of the planning process, when you're looking at whether it's Roth conversions or what capital gains I might be taking this year, if there's some choice, right? Wherever you have choice, you got to be looking at all these different areas that might be affected. So, what's the limit that I can do within this particular tax bracket on the Fed basis, on the state basis? What happens with my Medicare? And now what happens with this special $6,000 credit also, right?
Yeah.
So these are all things we look at when we're trying to, because look at 2025 isn't going to come back. You're only going to have this year. If you didn't do something that you wanted to do, like convert some Roth, or take some capital gains that you wanted because you're trying to reduce your exposure to a particular stock, you're not going to get that back. So in other words, if I'm at $75,000 worth of income as an individual tax, I've got $31,000 that I could take in some kind of gain if I decide. Let's say I have too much NVIDIA and I'm really looking forward to reducing that exposure. I could use 2025, take a look at all my limits and say, okay, I have, in this case, $31,000 worth I can take. Now I'm going to be careful here. I'm going to take 25 because I don't want to go a dollar over, because that's the whole object. But, and you mentioned this to me before, but just being able to kind of fill those buckets as each year goes by to try to accomplish your goals long term, right?
Yeah, because you don't get those years back. So
No.
a lot of things is a lot of people have kind of those income gap years where in the early part of their retirement, they're very low income because they're living off capital gains or assets, with assets, after tax assets with capital gains. And so they're like the, 12, they could be in the 12% bracket, or they could be like below that. So what we always, if you're looking at that tax situation, if you can fill that maximize that 12% bracket, you will never get that back if you go to a higher tax bracket.
Right, right.
And once your RMDs start, you can't really go back.
So this is the difference between tax planning and tax preparation. I mean, it's a huge difference. So if I'm a tax preparer, I'm going to say, oh, don't take that capital gain because it's going to increase your taxes, even though it fits within whatever bracket that you're trying to take, or don't do that Roth IRA conversion because it's going to increase your taxes. And it's kind of ignoring, the future component of what you're dealing with. So if I can convert some capital gains that's at 12% or 22%, and I never have to pay that tax again. I now have that in my cost basis, so to speak. I'm able to kind of have a better future by looking at that. And so tax planning is about looking at the future taxes, deciding what to do each year so that your overall scenario throughout the rest of your life is better than it might be, right? Not everybody can deal with it. Not everybody has choices on everything. But over a period of time, almost everybody ends up with some choices as to when they're going to do something and when they're going to take certain types of gains or what type of conversions they're going to do over a period of time. And so I think this is the most important. Nobody's doing this. Your tax accountant is doing tax preparation. They are getting you ready to lower your taxes in 2025. But what about 2026 to 2036 or 2046, right?
Mhm.
So during that period of time, can I reduce, and the compounding effect of that can be dramatic.
Yeah.
Uh, and reducing taxes, generally speaking, does not reduce your lifestyle. Spending less on travel or something to make sure you have more money is reducing your lifestyle. I'd rather try to make sure I can spend less on taxes first, or even maybe spend more today to spend less tomorrow, but spend less overall.
Yeah.
And that's where I think there's a huge hole in what people are looking at on how to deal with this. But that's where we come in, and we try to help here as much as possible. All right. So what's our next question?
So, with the Social Security Fairness Act, if my spouse never paid into Social Security, she has a government pension, but I worked in a private job and have a Social Security benefit, would they be eligible for spousal benefits?
Okay, so let me lay the groundwork. Prior to this Fairness Act passing, which passed with massive, I mean, there's only a few people that voted against it, which
Yeah,
is amazing in this
I think it
Congress.
was passed in
Last year.
Yeah.
Yeah, December, I think, of 2024.
Correct. Yeah.
Yeah, which is, again, surprising because it was after the election and all these things. Uh, if you had a government pension or you were a teacher, what have you, you weren't contributing to Social Security, your pension was actually was your Social Security
Yeah, yeah.
for all intents and purposes. But worst part was you actually had some Social Security income that you earned at some point. You couldn't get that either. Or your spouse had some. So tell us how this works.
Yeah. So essentially, in the past you had what was like a windfall elimination provision or a government pension offset, where if you had any kind of Social Security benefit and you had a government pension, the government pension would kind of offset that Social Security and you would receive no money. But by eliminating this, like the idea was that it helps people who are switching jobs. So they want to incentivize people to go into public service jobs. But if you don't start private service early, your pension's much smaller because you just don't have that long time horizon. So you prefer to stay in private because at least you get your Social Security. So they're just trying to combine both of it so you get both options. As a byproduct, the spouse, your spouse's benefit too. So if you're like, if you were working and you had a government pension, but your spouse doesn't, you'd be able to get that best of both worlds kind of thing.
Okay, so your spouse stays in private business, puts money into Social Security, qualifies for Social Security.
Yeah.
You're in the public sector of some type. You don't have Social Security. But now you can get half of your spouse's Social Security, just like you would normally.
Yep.
And so if they got $3,000 a month, you could be getting up to $1,500 a month,
Mm-hmm.
or you could get your own Social Security if it happened to be higher.
Yeah.
Right? None of which were available. You couldn't get your own Social Security even if you would have qualified. Well,
You
that's not true.
could.
It was an offset, which generally I never saw anything left over after the
Yeah,
offset.
no one usually got anything with the
Yeah.
offsets.
But theoretically, yes, you could. And then, so now that you can actually get your own Social Security, so if you don't have a spouse and you happen to have, qualifying number of quarters for Social Security prior to taking your public service job, you can get that. As well as your pension, which is nice. And Easton's right. It makes sense. I mean, they're eliminating the Social Security because you have pension, but if you came in late, now your pension's kind of small and you just gave up all the Social Security, right? So
Yeah.
now you can keep the Social Security and get the pension, so it allows people to go from, corporate world to teaching or whatever they wanted to
Yeah,
do if
it
they so
benefits
desire.
a lot of teachers, firefighters, police officers, and
Yeah.
just your government workers too.
Yeah, it wasn't really fair. That's why they call it the Fairness Act. That is a nice component, though, to be able to get your spouse's Social Security. So even if you don't qualify for Social Security, you still get that half.
Yeah,
which is,
we've been seeing a
which
lot
is-
of teachers,
right.
that had worked privately or maybe worked in the private sector for a little bit, getting some small Social Security benefits.
Yeah, that's good. All right, I think we have time for one more.
Well, how do you learn to spend again? After decades of saving for retirement, I have enough money, but I just I don't know, I can't spend it.
Yeah, this is something that comes up within the clientele on a regular basis. These are classified under good problems to have, right?
Yeah.
Which is where, you have this mentality of savings And that can come from all kinds of different places. But it's very strong, and it's why you've accumulated this money,
Yeah,
right?
scarcity mindset that
Yeah.
and it's been perpetuated for years. You've been saving for your working life, which is 40 plus years, right?
Yep.
And you kind of now have to switch on a dime. It's kind of a weird change.
It's pretty much impossible to a large degree, just in my experience. I've been dealing with this for a long time, to the point now where it's kind of interesting. I mean, I've had situations where, a client comes in with one of their children, and the child is basically just over and over talking about, well, they should spend more money. They're trying to be nice, and help their parent and say, hey, you've got more than enough. I know you, and maybe the parent's exaggerating that by always complaining about not having enough.
Yeah.
Come in for the plan, they have enough, and we knew they had enough,
Yeah.
But the problem is, what they're ignoring with the parent is, this is a psychological mindset that got them to this place, and they've been doing it. This parent's now 80 or something,
Yeah.
and yes, they could spend more money, but they don't like to.
It's a very much an emotional thing.
Yeah.
It has nothing to do with the numbers or the logic.
No.
They probably understand the logic of the thing,
Yeah.
but emotionally, it's just a hard switch to make.
Well, and they're always in the back of their mind thinking about that worst case scenario that could happen. And they're probably not completely wrong. They spend enough money, maybe they won't be ready for the next Great Depression. So there is this aspect of, but they're obviously thinking about a low probability event happening in their lifetime at some point in time that would wipe them out. And so they're still, and of course, there's always in the back of their mind this need for care,
Mm-hmm.
and how much that is. And they've got friends that are dealing with it, especially memory care, Alzheimer's care, and how expensive that can be. And so there's always this reason to save that goes beyond, we can put memory care into their plan. We can do all these things, and it still doesn't blow up because the money's there. And so we have had some clients talk about that and say, hey, we want to try to break this mindset at least a little.
Yeah, and it could be a small thing. Hey, let's try and spend an extra $100 on going out to eat or going to out.
Right.
It could be like, hey, we go see an extra movie each month or something
Right.
simple like that. You can start small. You don't have to. You don't have to break the bank. You can start with, how do I make my retirement a little bit more enjoyable? What upgrades can I do that won't. Well, I feel like I'm not being too excessive, but it makes my life a lot more enjoyable.
I kind of look at it, there's two groups of people. There's those group that are honestly trying to spend some more money. They want to. They're just trying to figure out how, and how to still feel comfortable about it, what areas they can spend money on. And that's fine. And that's where you're kind of really looking at the psychology and trying to figure it out. And I think you're right. Just start small and just keep on going. But there's another group that just never wants to do that. There's outside pressure. Oh, you have too much. I've seen it a lot with the kids. And they're trying to be nice and say, hey, we don't need the money. Go ahead and spend it, mom or dad or whoever.
Enjoy your retirement.
Enjoy your retirement. But they're really just making these people anxious. Because I have had clients whose greatest joy was their money and gathering the money and watching it grow and how much they got in dividends. And this was the fun, spending it wasn't what they were trying to do. And if somebody encouraging them to spend it actually caused more angst than needed. So you kind of need to know what you're dealing with, when you're trying to encourage your parent. But if it's you and you're kind of, in a spot where you feel like, okay, I'm being kind of silly here. I should be doing something extra. My mentality doesn't fit anymore.
It could be as simple as, hey, I always buy generic dish soap.
Right.
Maybe I switch to like Dawn dish soap. It
Yeah.
could be as simple as that, where
Right.
small changes where like I'm being a little bit extra frugal where I really don't need to.
Yeah. I have no problem with that. I just want to make sure that frugality isn't looked upon as something bad,
Yeah.
because some people think it's their joy. In the whole aspect of money, it is their joy. It's just that frugality. They love it. They love having millions of dollars and still hunting for cheap yogurts or whatever, and that's okay. It's whatever makes it work. I think for some of us, we look at that and say, well, that's not what I would do. That's fine. But that's how this person got to where they are, and they're afraid to,
Yeah,
modify
you gotta
that.
live your own rich life,
Yeah.
whatever that means
Yeah.
for you.
Yeah, I mean, I don't, anyway, but that's a surprising thing for me after 38 years of just realizing, that there's this mentality. Almost all my clients have that mentality, almost all of them. And that's how they got the money. And so it kind of, yes, we could spend more, but, again, they look at that balance sheet. They look at that. That's the joy, is making that grow. It's fun, or hey, I get X amount in dividends every quarter or something, and now I can get more, and whatever it is. So I've got lots of stories of very successful investors who basically just really enjoyed building up the money. It's okay. Okay, that's good for our show today. Again, as I mentioned, January 16th will be our next show. I'll try to do some of the summaries in between now and then, depending on when these Fridays fall. We'll keep the videos rolling for the most part all the way through the week also, so feel free to join us for any of those. It's a good time of the year to be looking at the market, see what's going to happen throughout this Santa Claus rally. There's a lot of key pieces that happen at the end of the year and at the beginning of the year that supposedly show what might happen for the rest of the year, which is always kind of fun to look at too. So anyway, we'll cover some of those as they happen. But anyway, thank you for joining us today. Very excited to get through some great questions today. Look forward to seeing you again in January. Thank you.